Welcome to Accounting High.
Check out the Cashflow Show. We discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cashflow Show. The Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. With Nikole and OKR.
What's up, Nikole?
Hi, Scott.
Welcome back, students, to part 2 of our SaaS Startup Series at the Cashflow Show, brought to you by Scott and Nikole. What's up?
Not much. I like your get up today. Reminds me of our Vegas trip.
We're red and white today for our SaaS Startup Series. This is our color theme for the day. Today, part 2, we're talking about our P&L structure for tracking KPIs.
So as we talked about last week, our SaaS startups is not the same as a normal operating business. And so when we break out the expenses and revenue on the profit and loss statement, we want to do it in such a way that it's helpful to then start tracking margins. And so we're just going to go through how to structure your P&L and then what KPIs you should be tracking and reporting on.
What's a KPI, Nikole?
Oh, good question. KPI is a key performance indicator. So it's some sort of metric or target.
And who defines what a KPI is?
Oh, good question. So there's industry benchmarks. And then there's KPIs that you might develop that are important for your particular business.
So it would be the business itself that determines what their KPIs are, what they're tracking. And is today your suggestions or the structure or the types of KPIs that are typically tracked most common?
So last week we talked about some key terms, right? Like we talked about customer acquisition cost, lifetime value, churn rate. So those would be some like operational KPIs, monthly recurring revenue, ARR. This episode, we're going to talk about more about the metrics that would come straight from your profit and loss statement that you'd want to report on.
So let's break it down then. Profit and loss is made up of profit and loss. So what's the profit side? That's revenue, right?
The first bucket would be revenue. That's right. And then we'd want to break that down by product or service line if you have multiple product or service lines.
And for early stage startups, do they typically know what their product is, or do they sometimes have a few irons in the coal or few irons in the fire, so to speak? Revenue model speaking, like, is it just the one product, or they have multiple products that they're pushing sometimes?
Yeah, usually they have multiple. Yeah. I mean, it depends on how far along they are or what type of business it is.
For example, for a startup company, what would be the breakdown? Or for startup for software, what is the breakdown of revenue? Just software, like subscriptions or your clients, your monthly subscriptions, that's one thing that you're tracking, right?
You might have enterprise clients versus smaller clients. You may have a hardware component to your business where you have to sell hardware in order to sell the software. So you'd want to break those out. You might have a professional service component of it. So you'd break that out. You might have, I'm trying to think of another example of.
And that's actually really important that you bring that up, because we talked about that on the first part of the series, where the professional service component might not be as profitable as the software component that you're selling. And usually some companies will split that off too. So maybe in the early stages, they do have other revenue components that they end up realizing that are not profitable, and they ditch them, scrap them later.
Yeah.
Cool.
Or you might have a software component. You might have like a training program. You might have, there's all sorts of different types of, you'll know what they are. And the reason we want to break down the revenue, one is so we can see the revenue that each service line generates, but we also want to break out the associated costs to deliver those services to deliver that product.
And that's the other important part of this episode as we go down and we talk about what those costs are and how they're going to be allocated to, because they could be specific parts of the company or the business.
Yeah. So then we get into your direct costs. So those are any costs directly tied to delivering the product or service. So that would be your hosting costs, payment processing fees, which we know can be quite high. I've heard different things here on your customer service, customer support. I sort of think that should go up in COGS. So I would put that there too, because the more you sell, the more customer service that you need to staff. And if you start losing customers, then that's an important metric to track, is like how much of your direct cost is your customer service costs.
But the better the product is, the less you need the customer service. And then you become a lot more profitable to begin with anyway.
That's a great point. So one thing that always would drive me crazy when bankers would be like, we have the best support, like you can call us at any time. And I'm like, but I don't want to call you. Like if your banking platform was good, I would never have to talk to you. And that would be my preference.
Sure. So the better the product is, the less costs they will have associated with that. So the more, they spend on some of these earlier stage, like research and development, and more they put into the product, and the better they make the product, the less customer service they need, the less churn they would have. Hopefully.
That's right.
That's the goal. Yeah, hosting costs is really big for software companies. They say that's a large part of their cost is just AWS now, the hosting costs. And when I say AWS, I'm talking about Amazon Web Servers, because that's what pretty much most companies are using these days. That wasn't always the case, but they've got their server farms.
Yeah. And you might have some internal hosting component where you're like more R&D versus your hosting costs that directly go up as you add on more clients. So it's possible you might want to break those out. So typically your direct cost as a percentage of revenue should be no more than like 20 to 25%.
Yeah, it's a different rule. It's not the 50, 30, 20. This is the 25 rule.
Yeah, 25. The 10, 25.
Yeah. All right, cool.
If you have revenue. So a lot of startups are pre-revenue. So then we want to start looking at margins as a percentage of overall cost. Yeah.
Yeah. A lot of startups, pre-revenue startups, you're not going to have that much in terms of revenue in the beginning anyway. That's why it's hard for you to come up with them, because usually pre-revenue, there is no revenue.
Yeah. In that case,
definition.
What I usually do is I'll show it as a percentage of total cost.
Fair. And this is all important to calculate a lot of these runway and the other things that are important to see how long this is going to work until they need more money.
Yep. So then we're going to get into our operating expenses, and typically we want to break out our marketing and sales expenses, since that's going to be, other than our labor costs or probably our R&D costs, it's going to be one of our highest expenses is our marketing costs.
Okay.
That way we can start easily calculating our customer acquisition costs and return on marketing.
Yes, more familiar terms. And R&D is important as an OpEx because you have tax credits associated with some of that. So you want to be very mindful of how you're tracking all of that as it funnels into your well-known R&D credits.
Right. So we want to make sure we're breaking out even your people costs for the people who are building something that is not fully developed yet. Mm-hmm. Programmers, right? They're building something to sell in the future versus these people are supporting the current product that's already being sold. Because otherwise, if we've already built one product that we're selling and then we're like, oh, let's build another product, then it's going to make our product that we're already selling look less profitable than it is, when really part of that expense is just us starting another mini startup in our startup.
Mm-hmm. Mm-hmm. Which happens as well. So very important to track all of those things. You've got your general costs and those. All right. So let's get into some of the other phrases.
Yep. And then the last bucket in your operating expenses is general administrative. So that's going to be salary, your admin staff salaries, rent, utilities, HR, accounting, legal.
Yep. All the stuff that isn't going to change much based on your outputs, at least. Those are the general costs that stay pretty static.
Right. And then you get into your net income. So if you want to back out, most SaaS companies don't have a lot of depreciation and amortization or debt. So usually your net income is your same as your EBITDA. Pretty similar.
What's the EBITDA mean?
You tell me what EBITDA means.
Earnings before income tax.
No.
No?
Scotty. Okay, it's
EBIT?
earnings before interest, taxes, depreciation, and amortization.
Oh, I thought it was income tax. Okay.
Well, tax is the T, not the I. Interest.
Interest, taxes, and amortization. Okay.
Yeah. So the reason people look at EBITDA is because if you think about it, right? Taxes, everybody's like taxes is a separate thing. We don't want taxes to throw things off when we're comparing apples to apples with another company. And then your interest is based on if you are using debt. So one company may have debt versus another that doesn't. And so when we're comparing apples to apples again, we want to make sure it's the same. And then depreciation and amortization are just stupid. I always thought that they were stupid. I'm like, let's just expense it and put it below the line when we buy something, a fixed asset. But they're non-cash expenses, basically. So,
well, to be clear, like usually this comes in the form of a very large purchase or when you acquire businesses or other things that happen. It's like a fictitious number. You just create it to allocate over time. So you don't write all of that stuff off at once. So it properly apportions the lifetime of that, of what you're going to use that product for, or that whatever that purchase was for.
right. So yeah. So depreciation would be a fixed asset, and then amortization would be, let's say you acquired a company, and so whatever you paid for it above whatever their equity is called goodwill. So it's just an accounting entry. So it's kind of like fake stuff.
That's the one that I was talking about. Fake. That the fixed asset's a real thing that you would use for a real period of time. But when you purchase an asset that would go into goodwill, that is something that you're just assigning a value to that. So you might spend $500,000 on some business, and you're acquiring the clients from that business. Those clients aren't physical; they're not depreciating, but that $500,000 should be allocated. The lifetime should be 30 years of those clients. And that's how long that $500,000 is going to be written off. That many years.
Yeah.
Slowly.
So, and typically when I'm doing an analysis for my clients, I actually do include interest in there. I take out taxes and usually depreciation too, because it's immaterial. But if you're running your business and you're trying to monitor things and you have debt, then that interest really is an expense for you. A acquirer coming in may look at your EBITDA, but if you're operating your business and you're just looking at it, like that interest expense really is part of your expenses.
It is, because it's cash leaving the door. It's money that's being spent versus your amortization. The money isn't going anywhere. You're just putting that. It's just a number on there. Money already left. This is cash flow. It gets back down to the cash flow.
It all comes down to cash. So let's talk about another cool calculation called the Rule of 40.
Ooh, we love our rules.
We love our rules.
Let's do it.
This is not a Nikole rule. This is a rule. I don't know who came up with this, but it's a common SaaS metric. So
sounds like a Nikole rule.
yeah, I'm going to come up with something different.
Yeah.
The Rule of 41. So according to the Rule of 40, a SaaS company should aim for a combined total of at least 40% when adding its revenue growth rate and EBITDA margin. So, for example, if a SaaS company has a revenue growth rate of 30% and an EBITDA margin of 15%, the Rule of 40 score would be 45%, and that would be excellent.
Okay. Completely over my head here.
Yeah, well, the reason we do that, because it's like a balance between growth and income. Because with tech companies, they can just run at a loss or non-profitable. They want to grow really fast and grow top line. But when you grow top line really fast, you're sacrificing your bottom line. And so the idea is we want to balance those two things.
Another good rule of thumb of 40. Cool. That's a pretty cool rule. It's pretty complex. We'll have some more information in the notes too. But to know how healthy the company is, and this is a general metric that you can look at, who would be looking at this number, or who's best suited to be seeing this percentage?
Yeah, so the founders would be looking at that. And then when they're presenting financial information to investors, that's something that investors are going to want to see too.
Do you have some examples?
So let's say company B, I would look at this monthly too. It's something you could easily just automate the calculation for. So let's say revenue growth rate, month over month growth rate is 15%. And then their EBITDA margin is 25%. You add 15% plus 25% and you get 40%. So that's spot on. It's basically your net profit margin, or we're using EBITDA in this, but your net profit percentage plus your growth percentage for the time period that you're looking at.
Dope.
So we don't want to neglect growth, and we also don't want to neglect profitability. It's a balanced approach.
Yeah, it is a balance. So you could be very, very profitable, but not growing, and then your number is going to be lower. That metric's going to be lower.
It's kind of like when we want to go out and have fun and drink, but then we don't want to be hungover the next day.
Everything in moderation.
Balance. Everything in moderation, right? Because if we go too crazy, then we're going to be hungover. But if we don't drink enough, then we're not going to have fun.
Yeah. Okay. Fair.
Now you get it. Now you got it. Okay.
It's a balanced approach. The rule of 40. So you should apply the rule of 40 to your nightlife too. Dope. Awesome. All right. Well, any other bits for our students here?
That's it for this episode. So next episode, we are going to be talking about what sort of reports you should be looking at on a weekly basis, on a monthly basis, and then quarterly, what sort of reports you should be giving to investors, and then some tools and tips for automating those calculation reports so it's not super tedious for you.
I love tools and tips. Tune in next week for part 3 of our SaaS Startup Series. Peace out, homies.
See ya.
Yeah. So you're drowning in cash flow issues. You run a business, but feel like it's running you. Customers won't pay, but you got bills due. It appears you won't have enough for payroll coming up soon. It seems like you running nowhere fast. You work hard, but never able to withdraw cash from the business. You get more customers, hire more employees, but still take home hardly anything. You feel like you're on a hamster wheel, frustrated cause the battle's always uphill. Even though you got a bookkeeper on your team, they send you reports, but you don't really know what they mean. Your CPA doesn't understand a thing about your business, at least that's how it seems. But if you want to get above water and grow, check out the Cashflow Show. This is the Cashflow Show, where we help the small business gain momentum and become profitable. This is the Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cashflow Show. The Cashflow Show, where we help the small business gain momentum and become profitable. This is the Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cashflow Show. Our advice will take you far. With Nikole and OKR.